Hello everybody, this is Calvin. So in this video I want to show you the power of compound interest and the impact of fees on your investments. So in this particular example, we're going to take a look at three different friends who all invest $100,000 when they're 30 years old. They decide to put it in their investment for 30 years. And so we want to see how much each would have after 30 years at 60 years old. So assume that each one of them gets an annual return of 7%. So here we have Andrew, who has a management expense ratio of 3% for his investments, so a mutual fund, for example. And so Betty will have a management expense ratio slightly better of 2%. And then Charles has a management expense ratio, let's say he has an ETF of just 1%. So the difference doesn't seem like a lot, just 1% between each one of these. But the difference is for Andrew, he's going to have 7% minus 3% fees of 4%. Betty is going to have 7% return minus 2% fees, which is 5%. And Charles is going to have 7% return minus 1%, which gives him a net return of 6%. So let's go into our calculator here. So you can go into Google and you can just search for compound interest calculator. And then you can just pull up any of the calculators on Google. So I'm going to use the one here on investor.gov, which is the US Securities and Commissions calculator, but any calculator will do. So we're going to plug in the initial investment of $100,000. And let's say they're not going to do monthly contributions. And for the length of years in time, it's going to be 30 years. And then the estimated interest rate, so we're going to do Andrew first. So he has a 4% net annual return. So we're going to put 4% here. And then we're going to set the compound frequency to annually. So once you click calculate, you'll see that Andrew has $324,000 or so. The 30 years. Okay, so now let's go over here and let's go take a look at Betty here. So Betty has a 5% net annual return. So we're going to change this 4 here to a 5. And everything else stays the same. I'm going to click calculate. And you'll see that Betty has, in 30 years, $432,000. So you can see already that's going to be a huge difference over 30 years, that Betty is going to have more than $100,000 more than Andrew. And let's do Charles as well. So Charles is going to have a net annual return of 6%. And if we click calculate, you'll see that Charles is going to have $574,000. So over the long run, it really makes a big difference, the compound interest. So even if you have just a 1% difference in fees, you'll see that you're going to gain over $100,000 more over 30 years. So obviously Charles has the best amount of money after 30 years because he only had 1% of management expense ratio, which gives him a net annual return of 6% versus Andrew, who has a net annual return of only 4% because his management expense ratio is really high for his fund, which is he only has $324,000. So basically the difference is like $250,000, which is like $250,000 over 30 years. So that's why it's very important to look at your fees, and it makes a huge difference to your investment portfolio over the long run. So that's why you have to be very, very vigilant about picking a fund that has a low fee. This is very, very important, as you can see with this example here. You could have $250,000 more just by picking a low fee fund. Okay, so hopefully this video was helpful. Thanks for watching, and I'll see you in the next video.